back. We're back. We're gonna watch how does the rising interest rates control inflation since the Fed just increased interest rates yesterday, and it seems like a pretty pertinent thing to try and get a small grasp on since it does, affect most people because it affects how what your interest rates are for like houses. It's mainly the only one that I know, but it could also affect cars, food, all that other shit, and really your quality of life. But I think a lot of people assume that it doesn't really affect them because they don't have that much money or they're not taking as much loans or whatever the case is. Like it doesn't really matter to them. But in over years, the difference between a 3% interest rate and a 6% interest rate on anything over years is just gonna compound into millions. So it's very important to try and get a small grasp or understanding on the topic. But also, it's Thursday, so it's reset day, and you'll see what I be doing on resets. What the fuck? The way I play this game is that it has this thing called rest bonus. So I just started it on Chaos Engines and Unitask, but so this guy has 2 Guardian Raids. This guy, well, it's not a good guy, but this guy has 1. This guy has 0. So I played them yesterday. So today I'll play these 3. And then the next day I'll play these 3. So I only played 3 characters now from any given time. And it saves me a lot of time, but also it gives me 6 drops worth of shit rather than 3 drops worth of shit. So like even though I'm only playing 3 characters, it's like I'm playing 6 characters in the amount of time that I'm playing 3 characters. So it's nice. It's a pretty cool system. I've never seen it before in any other game, so it's pretty dope. Alright, let's watch this Economist video though.
When central banks raise interest rates, it's big news.
Bankers judging that the only way they can try to pull down inflation is to carry on raising interest rates.
We're going to see rising rates.
Rising interest rates that will make the cost of borrowing go up.
It can send ripples across the whole economy. It can sink consumer confidence, result in fewer jobs and lower wages, and cause stock prices to fall.
If they go too far too fast, it can tip economies into recession.
So, why do central banks raise interest rates? Let's start with the basics. If you borrow money, you'll have to pay back a little extra to make it worthwhile for the lender.
Well, I think we can make you this loan. You have a good reputation. We know you're reliable.
I'm glad you think so.
This is the interest rate.
So if you are taking out a loan, you want the interest rate to be as low as possible so you don't have to pay that much back.
On the flip side, if you want to save money, then a high interest rate means you can earn more on your savings. See it as a reward for leaving money in your account. But the size of your reward depends on the circumstances.
There's no
So it's pretty wild because a lot of people assume that they're like, so they have like their bank account, they have their savings account, and they go under the assumption that their savings account is making them a little bit of money. But the amount of money that you make in a savings account is usually offset by the fees that they have in savings accounts. So a lot of savings account have like a maintenance fee, or it has a fee for like a holding, or you have to have a certain amount there, or you need to be able to be putting a certain amount into the savings account for it to not incur fees. So that's like money that you can't be using anyway. Some more drastic ones have a withdrawal fee, which is insane, right? And the difference that goes for, like, sometimes it's good to just hold cash, like especially for safety, but if you're gonna have extra more than what you would need in like a 6-month period, then you might as well put that in something that you deem safe, whether that's something you deem safe as an ETF or a mutual fund or a company that you like whatever you think is safe for you, it'd probably be a better idea to put your money there, keep it there, rather than just having it sit in your savings account. But if you're having it sit in your savings account because you're looking to make a down payment, or you're waiting for a market downturn, or like you could go make a whole video on waiting to invest. But if you just have a plan with that money that you're doing, then that's good. Like as long as you have a plan, that's great. But if you don't have a plan and you're kind of waiting to make a plan, then you might as well put it in an index fund, right? And take it out in a year. As long as you don't need it within a year, then you're good. Because then there's a big difference between getting taxed on short-term gains and long-term gains, and that's like I said, those are all whole other videos.
No single interest rate in the economy. You've got thousands of banks setting their own commercial rates. That's all influenced, though, by the interest rate that the central bank sets.
A central bank is like a bank for banks. Just like you and your savings account, banks also earn interest when they leave money with a central bank.
Commercial banks have these things called reserves. So that's a bit like their cash on hand. Commercial banks lend those excess reserves to each other at an interest rate, and they also can deposit their excess reserves at the central bank. And when they do that, they can earn an interest rate. Ordinary people can't access the interest rate on the excess reserves, but it still affects them.
And that's the idea. When central banks raise interest rates, they're trying to control inflation, how fast prices rise for everyone.
They were 129, now they 139, and that's in the space of 4 weeks.
Central banks like the Fed or the Bank of England or the European Central Bank are all trying to hit an inflation target of 2%. Interest rates are a really powerful tool that they have to do that.
If inflation is seen as too high, that's when banks raise interest rates. The change spreads through the financial system and slows down the rate of inflation. Here's how. A rise in interest rates from a central bank means that a commercial bank will earn more on their reserves. They might make more from keeping their money in a central bank than lending it out. So if they do lend it out, they'll raise their interest rates to make it worth their while. How that affects consumers depends on the economy. Take mortgages. In places like Finland or Australia, lots of people have mortgages with variable interest rates.
If you've got a variable rate mortgage where the interest rate that you pay is linked to the central bank's interest rate, then higher interest rates mean that essentially immediately the higher rate will translate into less cash to spend on other things.
Less spare cash means households will spend less. And less spending means businesses will be warier of raising prices. This should lower inflation. In other
That's like craziness, because prices are going up and people are definitely spending less money unless it's like a complete necessity. Like they need gas to get to work, and gas is just going up. They said that they thought that gas and food prices would go down, but of course, supply chain is what everyone is talking about, saying like, oh, the supply chain is blocked. There's a supply shortage because of COVID. We're going influxes of people getting COVID, people not getting COVID, and in between those influxes is where the pain points of supply comes in, of like the demand stays the same. Sometimes it gets higher while people have COVID, but then the supply is getting lower because people have COVID, but they also still need the items that they need. So that's understandable. But then you also have gas prices going up, and people are looking for the lower prices, and you would think competition would at least somewhat keep it at a steady pace of rate, but it just keeps going up every week. maybe almost every day. Like from the past maybe 2 months, it went from like 4 something to 6 something, and it's reaching 7, 10 in some certain places that are like more expensive, and certain gas companies are already preemptively going to $10 in the richer places, and that's fucking crazy. $10, $10, bro. Like if you were working Uber, or if you had a commute to a $8 an hour job, a good portion of your money is not only going to rent already, but now it's going to car maintenance and gas. Then you have what, like 20% left for food and everything else? Like, holy fuck, bro. Shit sucks.
Other countries, like America or Canada, a bigger share of mortgages are set at fixed rates. People with fixed rates are protected against the direct effects of an interest rate rise, but will still feel an indirect impact.
Higher interest rates mean that mortgages will become more expensive. If that is affecting all new buyers, then house prices will begin to fall. And that will make everyone who owns a home feel poorer, and therefore they might spend less. Lower spending will translate into lower inflation.
And it's not just consumers who will tighten the purse strings.
When interest rates rise, then businesses will find it more expensive to borrow and invest.
How is inflation rising if we're doing less spending? If she just said that less spending lowers inflation, why the fuck is it still rising right now? Like, I get that's why they're hiking up the rates to try and combat inflation, but why? I feel like no one has enough money to spend that much. You know? I mean, like, I spend like an okay amount of money, but that's definitely not as much as I was spending before. So why is it still going up? I mean, that's just me, of course. You know, that's one person out of the 400 million people that are in America. But I would like to think that we're all relatively somewhat close, unless you know you're in the top 5% or whatever. So that's still fucking crazy. Jeez.
That generally means less economic activity. It might mean fewer jobs are created.
Fewer jobs and lower wages could mean less money for households, and consumer confidence might suffer, which also means less spending.
People are grappling with a decline in real wages, meaning their money buys less.
When interest rates rise, that will tend to slow down spending, investment, and generally depress economic activity.
Oh, damn, I missed one.
Overall, that will make businesses more reluctant to raise their prices, and that will tend to pull back inflation.
It sounds straightforward, right? But the trick is judging how far to go. In 1981, the Federal Reserve, America's central bank, allowed interest rates to rise to a whopping 19%. The move curbed inflation, but it led to widespread economic pain.
I regret to say that we're in the worst economic mess since the Great Depression.
It is very difficult to get inflation under control without severely denting economic activity. In America, it's been over 70 years since they've managed to get inflation down from over 5% without causing a recession.
A little inflation is okay. It keeps the economy moving.
I think we're at 8% right now. 8 point something percent inflation.
At a sensible speed. But inflation staying high for too long is a problem. Higher prices means employees will need higher wages, pushing up costs for businesses. That could drive up prices further. But
That's wild because I'm pretty sure wages haven't rise with inflation since the 70s. So what the fuck is he talking about, right? Maybe for like rich people it's gone up, but for poor people it's definitely has not gone up. That's why there's people almost rioting. They're doing like a bunch of peaceful protests on fucking $15, which isn't even equivalent to uh the 70s, whatever, $2.30 that they were making. It's not the same with the account to inflation. You'd need like $23. So them asking for 15 is like asking for $7 an hour back when it used to be $5 an hour. So
potentially leading
fucked.
to an upward spiral of wages and prices.
Retail inflation in India has surged to 7.8%. The combination of tepid economic activity and high inflation poses serious challenges for Indian economy going forward.
Jesus fuck.
Central
Dude.
bankers are really concerned about setting expectations of inflation. The idea is that if it can show that it is credible, that it will always act to get inflation back down to 2%, then maybe it won't have to, raise interest rates and then lower them in this kind of seesaw fashion.
Raising interest rates can slow an economy right down. The trouble is, the brake pedal has a delay. It can take as long as 2 years to see the full results from interest rate changes. Central banks know this, so when they set interest rates, they're actually trying to read the road ahead. But predicting the future isn't easy.
The problem is, it's difficult for the central bank to work out whether the inflation will fall back on its own.
And even when central banks do get it right, they might still cause a crash. It may be a blunt instrument, but raising interest rates is still central banks' main tool for taming inflation.
Central bankers would say that yes, raising interest rates can be painful. Slowing down the economy is not fun, but it's worth it. It's worth it to get low and steady inflation so that in the long run, you don't have to think about it. Thank you for watching. To read more of our coverage on interest rates, click the link. And don't forget to subscribe.
That's pretty good. That was pretty cool. But a lot of the systems they're talking about, it seems like maybe because they're saying it's going to take, a few years for us to see the effect. Excuse me. But when we saw the pandemic and we saw what it did to supply chain and what it did to people working and the amount of money that was being put into people's hands, why would we not assume that inflation would follow that? And instead of lowering the rates back in 2020, we lowered the rates. Why would we not increase the rates then? When people had the money and we could be preemptive about what they've seen, 100 or dozens of times. Just doesn't really compute. I definitely don't know enough about the subject to give you a conclusive answer there. That's like my question. It could be, I could be misinterpreting the situation of getting that influx of cash. Like maybe that would have, getting all that cash they thought it would like slow down inflation. I don't know, but why would it, doesn't make sense? Why would it not just like keep the rate steady at that point? If there was so much uncertainty, why wouldn't they just keep the rate where it was rather than lowering it and then coming back to 2 years later be like, oh yeah, now we need to increase it again slowly? And people are like freaking out that they're gonna increase it a fuck ton, but because they don't want to lose money, they want to get their shit out of the stock market first, and then everyone else is just, people that don't have money in the fucking stock market are just fucked. But it's interesting. Gotta watch more shit on this. It's pretty interesting. But I'll see you guys later.